Today, bonds are back to producing 5%, which is about half of what the average annual return on stocks has been. So that 60-40 portfolio is giving you an expected rate of return that's about 80% of what you would get on stocks. So you're getting a high ratio of the return with meaningfully lower volatility and risk.
Mark Curtazzo explains what this new era of higher interest rates means for your portfolio.
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Remember last year when the traditional balanced portfolio of 60% stocks and 40% bonds was declared obsolete by many financial commentators? Well, it certainly failed to deliver the goods, declining about 16% in 2022. And the bond portion did not offset the stock declines as bonds suffered their worst losses ever. Well, this week's guest says with the rapid rise in interest rates, there has been a massive change in fixed income returns, and the traditional safe assets are back. And that means it's time to reset portfolios. I'm listening. Our guest is Mark Curtazzo, Senior Vice President and Financial Advisor with the Wealth Enhancement Group, an independent financial planning firm he merged his Macro Consulting Group with in 2021. Curtazzo founded Macro Consulting, an independent investment advisory firm, in 1992. Curtazzo has received numerous awards and accolades, including being named a Barron's Top Advisor for 13 years. We are also delighted that he has been a frequent Wealth Track guest since our 2005 inception. I asked Mark to describe what he calls the massive reset in returns.
Well, we've seen interest rates have a dramatic change. Roughly 2 years ago, they were at Treasury bills were paying about 0.1%. To give you some perspective on that, as I stated on last show, on $1 million, you were earning $1,000 a year interest. A year later, the rate went up to 2 percentage points, which were 20 times what you were earning on that Treasury bill. And we thought 20,000 on $1 million relative to 1,000 was great. And here we are a year later, and you're earning about $50,000 a year interest on a Treasury bill. So that changes a lot if you've changed a lot. And one of the very powerful forces in the universe is inertia. And so people kind of were doing one thing and they continue doing that. We've had a massive reset that I think warrants taking a look at everything to see should you be making changes.
Aside from the fact that, gee, let's get some short-term instruments that are going to give me 5%, what kind of changes should we be making both in the portfolio itself and maybe in our heads?
Just because Treasury bills and short-term traded instruments have adjusted dramatically, not all fixed income has. Many banks are still paying 1% and change. The average 6-month Treasury CD is only paying about 2%. So the difference between 0.25% and 0.3%, people weren't looking at that because it was basically a rounding error to zero. The difference between 2 and 5, depending on how much money you have in it, is significant. So taking a fresh look and not just assuming that you're earning what the current rates are is very important. And doing reviews with clients with a fresh eye on existing portfolios coming in has been very, very valuable for them because they just assume that everything in their portfolio has adjusted with current rates, and that's not always the case.
Let me ask you about the 60-40 portfolio, that traditional mix that in 2022, was declared by many to be obsolete.
Yeah.
What is your view, number one, of that 60-40 construct to begin with and its obsolescence?
Well, I think that for decades we had a bull market in bonds. And so they were not only mitigating risk, but they were contributing performance to that 60-40. So you might have gotten 75 or 80% of the stock market's performance with that 60-40 mix because the bond piece was contributing not only as a dampener from a volatility standpoint, but also producing return. Right. In the beginning of 2022, when interest rates were at 0.1%, the bond piece was mitigating risk. It just wasn't adding performance. So your risk reward ratio on that wasn't very high. It was dampening volatility, but it was also reducing performance because the bond piece was producing so little return. Today, bonds are back to producing 5%, which is about half of what the average annual return on stocks has been. So that 60-40 portfolio is giving you an expected rate of return that's about 80% of what you would get on stocks, with only half of your 60% of your portfolio being tied to the equity market. So you're getting a high ratio of the return with meaningfully lower volatility and risk because the bonds are historically a good dampener.
Last year, however, 2022, bonds had their worst performance ever. Yes. In history. And so that has shaken up a lot of people's confidence in bonds as a dampener of risk, right? Should we be rethinking the role that bonds play in a portfolio? And if so, how should we rethink it?
I think that the starting point of that observation period is what drove the concern. We had rates going from 0 to 5%. And so that significant rise in interest rates hurts bonds, and with such a low coupon, you didn't even have very much cash flow coming from the bonds that was getting reinvested at the higher rates. So you had a very unique situation where you had historic low interest rates that spiked up dramatically. If you think rates are going to go from 5 to 10, another 5 percentage points rise, that would hurt bonds. But I think if you stick with intermediate term bonds, that's going to have significantly less of an effect. If you were to buy a 5-year bond today, yielding a little bit more than 5%, and you hold it to maturity, you're going to make 5% a year on that, as long as there's not a default. And that's a workhorse. That is something that is producing meaningful cash flow and return for your portfolio. So if I jumped in a time machine and went back to the beginning of 2022, I would be concerned about a 60-40 portfolio. But I actually think that from where we are now, the metrics are more in line with historic norms and much more attractive on a risk-adjusted basis than they were even a year and a half ago.
And
Correct.
so as far as our expectations for returns from bonds and the role they play in a portfolio, what should it be now?
I think that if you just got a 5% rate of return with the high quality, low risk of default fixed income right now, and having the equity piece be the contributor to growth, I think that's a good mix and a good ratio today.
But 5%, it sounds great relative to where we've been, but if you compare it to inflation, for instance, so the real return and on an after-tax basis, it's really not that great, right?
It is why you have stocks, because over the long term they're better hedge against inflation. But many people can't stomach the volatility of having a higher percentage of their portfolio in equities. So this is something that is based on somebody's willingness and ability to take on risk. And so that 60-40 portfolio gives you a good ratio. You're getting the lion's share of the upside of the market. And if we average 10% a year on the equity piece and we're earning 5 on that 60-40, you're getting 80%, an 8% annualized expected rate of return with meaningfully less volatility if you're in intermediate term bonds than what you would get in the stock market. So 80% of the upside, about half of the risk of equities. I think that's a good mix and a good ratio. If you have this in a retirement account, the taxes aren't hitting you each and every year, so you do get to compound at that gross. Bonds are there for safety and protection. The equities are there for the growth, and between the two, I think you can outpace inflation over the long term, and it might be a smoother ride.
If I'm looking at the 60-40 portfolio, the traditional one, it's usually talking about the S&P 500. And should we be rethinking that? Because the S&P 500 is not inexpensive at the current moment.
I think that if you're building a 60-40 portfolio, it should be a globally diversified market cap, much more expansive market cap exposure than just the S&P 500. The last time we had a significant run up in a handful of tech-oriented stocks that drove the S&P 500 was the end of the 90s. We got to valuations, in and around the neighborhood that we're at now, and we had a decade where the S&P for the next 10 years was negative, not negative adjusted for inflation. You actually had less money 10 years later. So a globally diversified portfolio, had much better performance and returns. And what you pay for something is important. So valuations are high, and not overweighting or solely indulging on large cap U.S. stocks, I think would be prudent with these levels.
And let's talk about the 40% that are bonds. You've mentioned the 5-year maturities a couple of times as being the sweet spot in the market right now. So where would you be investing a bond portfolio now?
I think you need some diversification there. The tough part for investors today is that short-term interest rates are higher than long-term interest rates. So you get this mentality of, why would I lock up rates for 5 years at 5% when I can get 5.3% on a treasury bill that's much more liquid and I can tap at any time? People had that conversation in the 80s. Why would I lock in 15% when I could buy an 18% money market? Well, because you protected that yield for that full term. So having some money where that 5% is protected, is locked in, you know that you're going to get that each and every year for the next 5 years, gives you predictability.
Your clients have told you that they want predictability of income. And where are you telling them that they can find it?
Well, depending on how much income they need relative to the assets that they have. Building a bond ladder or building a portfolio that has bonds even, where they're all maturing out, 10 years from now, and they're just going to be using the interest off of it, not touching the principal. If they have a smaller percentage withdrawal need, that is, very, very viable solution. Some people wanting some guaranteed, predictable lifetime income, with some type of guaranteed annuity payment or something like that. The good news with that is, with interest rates being significantly higher, the amount of money needed to fund a set dollar amount on a monthly basis has gone down dramatically. We ran some numbers on somebody needing a 30-year cash flow, life expectancy, to fund $5,000 a month a year and a half ago required about $1.5 million of cash. Wow. To generate that $60,000 a year for a lifetime income. With about $900,000 today, generate that same $5,000 a month. So it was 50-60% more expensive to generate that same income. So rates rising for people who need guaranteed predictable income, and you're locking in that rate for life. You've got mortality credits. So there's things that are more valuable about that today than it was just a few years ago.
So again, it just sounds like you've just got to reevaluate everything given the new environment that we find ourselves in.
The question that we try to ask people is, if you didn't have anything invested today, you had your $5 million cash, would you build the portfolio that you have today? Because what happens is U.S. stocks have done better, growth has done better than value, and you get drift. And sometimes that drift is a little, and sometimes that drift can be meaningful, where you end up very lopsided, and the markets do have ebbs and flows, and you don't want to be maximum exposure right before that tide turns.
Mark, one of the things that you and I have talked about many times in the past is the fact that when you retire, can make a big difference to your financial outcome. And if you happen to retire in a bear market and you are taking money out of a portfolio that is declining in value, you can run out of money pretty quickly.
Yes.
So who knows what the current environment or the future holds for us in the next couple of years. So how do we avoid finding ourselves in that circumstance?
Well, you can try to avoid being in that circumstance, or you can manage the risk of being in that circumstance. If 5% is enough for you to generate the income you need to live off of, maybe you don't need a lot of money in the stock market right now. Right. We've talked in the past about our three brothers example, where someone retires with $1 million, they buy the S&P 500 index, and they take $5,000 a month out. The person who retired in January of 1997 with taking $5,000 every month since then, their $1 million is $3 million now. Their principal has tripled and they've generated $60,000 a year of income that whole time. Someone who retired 3 years later, January of 2000, $1 million in the S&P 500 index, taking $5,000 a month out, they ran out of money 7 years ago.
Wow.
So timing is very important, and you can mitigate risk, you can manage it, you can transfer it. There's different ways that you can handle that. I think sometimes it is, what is the risk that you're trying to protect yourself from? If it's that tech stocks don't do well, but the rest of the market does, small cap does, international does, diversification is a very effective way and cost-effective and effective way of managing that risk. But what the market doesn't seem to price well is sudden unexpected events, a terrorist attack, a financial crisis,
COVID.
Virus, right? And so diversification is not an effective tool for protecting, that is a risk asset, non-risk asset, delineation. So that's where transferring risk becomes more effective, having some lifetime income, having things that hedge the equity markets, having a significant decline. So that will reduce the volatility or the impact of a sudden significant impact. Because the sequence and the volatility often have a greater impact than what the long-term average is. And so, when people look at dollar cost averaging in or modern portfolio theory, it doesn't really show the impact of cash flow in and cash flow out of a system. And once you start drawing from that portfolio, especially if it's a constant dollar amount, if your principal gets hit, now that becomes even a larger percentage drag on the portfolio. You may not be able to turn that around.
So how does one hedge against that risk?
Well, if you have enough liquidity to wait it out, that could be one way of addressing that risk. One of the interesting conversations we have with clients is if they have $3 million of their portfolio in equities, saying to them, at some point, this is going to decline $600,000 or more. And it's going to be something that is an unexpected catalyst, something that's shocking. That's why the market reacts as violently as it does. And, are you going to be okay with that? Doing a fire drill on when this happens, how are you going to react to that? And if they say I would be very nervous or concerned, then that's a different conversation of whether or not they should have that much money in equities.
We've had recent examples. Again, last year, there was a massive outflow, record outflows from municipal bond funds because municipal bonds, declined in double digits, and people weren't expecting that. So they bailed out, and of course, the market has come back. So I love the idea of a fire drill of just, what would you do? And let's adjust your portfolio now so you don't have to go through that $600,000 loss in your equity portfolio.
Or for that part of your portfolio, maybe you can stomach that volatility knowing that this is your long-term money, and it doesn't matter what it's worth 12 months from now. It matters what it's worth 10 years from now. And the difference between doing a portfolio fire drill and an actual fire drill is we are going to have a bear market that is 20% or more. So we are preparing for something that will almost assuredly happen. Are you prepared on how you're going to feel about that or react to that? Because if after the market declines, you get out because you extrapolate it's down 20%, and if it keeps going down, I'm not going to have enough money, you're going to be making an emotional decision and probably do the exact wrong thing at the exact wrong time. That should be in your expectations for that part of your portfolio.
You mentioned to me that there is a new element creeping into your conversations with retirees, and that is the issue of helping family members financially. Do you want to talk a little bit about that and why that seems to be coming up more often these days?
There's a lot of conversations about living your best life and enjoying yourself while you're still young and healthy. And, I think that there's movements toward that. And so we are seeing our clients having their, children or grandchildren asking for their inheritance early or to get some, support and help so they can enjoy themselves for some window of time. When the markets are good and they have some excesses, it seems, easier to say yes to that. But we need those excesses. We need that extra buffer for when the markets don't do well. And so when you're boarding an airline and they go through the safety procedure, when the oxygen masks drop, first thing they say is you need to take care of yourself first before you try to take care of anyone else. And so making sure that that additional stress and burden on the portfolio is sustainable is very, very important. And if I have to be the bad guy to tell them that no, they can't help, or that maybe there's a different way that they can help or a different level, making sure the clients are taken care of and not having guilt drive their financial decisions is really, really important.
One investment for a long-term diversified portfolio, and I'm going to mention the fact that the last time you were on Wealth Track, you recommended an ETF, and talk about hedging your risk, and it was the Innovator U.S. Equity Power Buffer. Explain, I think it's done pretty well, right? So explain how that works, and it certainly seems to be a good vehicle, again, for hedging against market declines.
There are times where transferring risk makes sense, and there's lots of different ways that you can transfer that risk. And it's determining some type of level of protection, and for that you're going to typically get some type of cap. Now that rates have gone up, cost for hedging has actually come down because the cost of money is your money is more valuable. The cost of money is more valuable. So I think that avoiding risk, managing risk, and transferring risk are all effective in different environments, and all effective for different goals and objectives. And so, the concept of that is just be open to taking a look at transferring risk.
Right.
And what's the pros and cons of it? Maybe the appeal of that isn't as great for what your needs are. But to not be educated about it and not look at those types of things, I think makes sense. And if for somebody who wants more absolute predictable protection, transferring risk is more effective.
So what would your one investment be today for a long-term diversified portfolio?
Well, I was trying to win the award for the most boring one investment recommendation that you have all year, but FDIC insured high-yielding money markets and government securities money markets right now at north of 5%. Are very, very appealing and very attractive for parts of people's portfolio. And looking at where your cash is, cash sitting in a brokerage account that you're not using, could have a very low yield, money that is accumulated in the bank. Take a very deliberate look at all of your idle money that you're not going to need for the next 6 months or so, and you look at the bank rates. It is surprising, with rates as high as they are, how many significant pools, billions and billions of dollars, that are sitting earning 1%, 1.5%. So this is a massive reset to yields, and the differences between the standard default money market and deliberately making a choice to move it can be 2, 3, 4 percentage points more. And if you have a large balance, that's thousands of dollars a year. I know it's simple and boring, but it's so easy of a risk-free pickup in return, which is rare, that normally you have to take more risk to get more return. This is just a little bit of effort and shopping. It can be thousands of dollars a year difference to you.
Really good idea, and it sounds boring, but the returns will not be boring.
Yes.
So, Mark Curtazzo, so great to have you again on Wealth Track. Thanks so much for this refresher course on the new market environments we find ourselves in.
Thank you, Consuelo. As usual, it was wonderful to be able to spend some time with you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is design your portfolio with the worst 2% of market conditions in mind. That contrarian piece of advice comes from William Bernstein, neurologist turned investment advisor and author of the investing classic, The 4 Pillars of Investing: Lessons for Building a Winning Portfolio, which was just published in its 2nd edition 2 decades after the first. In an insightful and succinct Wall Street Journal interview, Bernstein discussed a major theme of the new edition: It's a huge and usually fatal mistake to design a portfolio without focusing primarily on those approximately 2% of times that will cause you to lose your nerve and violate Charlie Munger's prime directive of compounding. As Munger, who is Warren Buffett's partner, puts it, the first rule of compounding is to never interrupt it unnecessarily. Bernstein goes on to recommend holding plenty of safe assets like dull, low-yielding Treasury securities and being prepared to see your risky assets get periodically and hopefully temporarily slaughtered. Long experience has led Bernstein to conclude that it is better to hold a chunk of safe assets with their suboptimal returns than holding a ton of high-risk assets that most investors abandon in those worst of times. Next week, part 2 of our rare interview with Stephen Romick, FPA Crescent's founder and lead portfolio manager, shares 30 years of investment lessons. In this week's extra feature, Mark Cortazzo recommends a book to help us visualize our future and improve it. Please follow us on Facebook and our YouTube channel. Thank you for spending time with us. Enjoy your weekend and make the week ahead a healthy, profitable, and productive one.